welcome to the call today. I am Casey Frazier. I'm the Chief Investment Officer of Versus Capital. We're a boutique asset manager based in Denver, Colorado, and we focus on real assets investing. I'm pleased to be joined today by Dr. Peter Linneman. Dr. Linneman is one of the preeminent real estate scholars in the world today. Dr. Linneman was a longtime professor at the Wharton School of Business, where he was the founding chairman of the Wharton Real Estate Department. I won't say how long time that was, Peter. You're welcome to disclose that, but I'm trying to be a gentleman here as we get this
Well,
started.
it was like 34 years, and I've been retired from that faculty for 13. So long time is the right phrase.
All right. Well, fair. You disclosed it, not me. Peter's also the author of the Linneman Letter. The Linneman Letter, for those of you who don't know what that is, it's a quarterly research publication that Peter and his team put out for the commercial real estate sector, as well as just for those who are interested in what's going on in the overall geopolitical and overall economic markets. Versus Capital is a subscriber to the Linneman Letter. We think it's very valuable research and something that is part of our investment process on an ongoing basis. Dr. Linneman is also the founder of Linneman Associates, which is a leading real estate advisory firm and is actively involved with the Sam Alimu charity, which we are going to put a link to at the end of this video. Peter was telling me Sam Alimu is actually just a shortened version, but Peter, why don't you give us the full
Yeah, when we adopted it, we had the program is Save a Mind, Sam Elimu, which is education in Swahili, and so it's like many things. For those who know, it makes complete sense. And but I haven't. Like it's somebody's name. That's not a silly thought, right? So, but it's Save a Mind, Elimu. You can get information at that website or on my website. You can get it, and we appreciate your support in mentioning it. Thank you.
Yeah, happy to. Well, we think that there probably hasn't been a more interesting time to talk about real estate, probably since the global financial crisis. So we're really pleased to have you on today, Peter. I mean, we're in the midst of negative headlines almost every day coming out about how commercial real estate is in trouble and struggling. We're obviously seeing the focus and impact of higher interest rates on the overall economy, and obviously real estate is impacted by that. And then this persistent inflation after kind of the global pandemic and some of the things that happened there. But we try to keep it simple here. We're going to try to break this down into three pieces. We often think about real estate as a three-legged stool. We think about the demand for real estate and have to understand where we are from a demand standpoint today and where we're going. So I'm going to pick your brain on that a little bit. We go back to our old days and sitting in classes like you taught. We also know we have to understand what's happening in supply. So we'll pick your brain on that. And then the third leg of the stool is what we consider the demand for owning real estate, which I'll want to peel back the onion a little bit there and get your thoughts on that. It's really kind of more capital markets related rather than real estate fundamentals. So I think we should probably start with the demand side. How do you think about the drivers for real estate demand? Is it GDP? Is it employment? Is it immigration? It is a combination of all of those. And what does that look like today? And where do you see that going in the near and midterm future?
Yeah, I mean, basically, if you had to do a simple statement, I say real estate exists to serve the economy in all of its dimensions, of which GDP is a measure, employment's a measure, industrial output's a measure, online sales is a measure, retail sales. So there's a lot of dimensions of the economy. But you want to try to track demand, you're trying to track the economy. So those who have ever seen Linneman Letter know I track a lot of things. Not all of them are equally weighted. But the reason I track a lot of things is I view the economy sort of like the painting behind you, which is if all there was one brush stroke, it would mean nothing. No single brush stroke in that painting means anything. But when you can get the right perception of a whole lot of meaningless brushstrokes, it means an image. And it's an image that can move you and inform you, right? So that's what I try to track: consumer confidence and interest rates and so forth, and GDP and industrial output and employment. All of those matter, some more for some sectors than others, right?
Sure.
None completely determinative, and each with their then own localized dimension. So where are we? The economy. The economy is in pretty good shape. It's always in kind of flux. I'm 73 years old, and a few years back, I said my entire 73 years of life, the economy has always been faced with immeasurable problems. You just kind of, it's wars and pestilence and plague and bad education and bad governments, and just go on, the whole list. And that whole list is really existed my entire life. And yet the US economy is amazing in that it basically grows, except every once in a while it doesn't. It pauses growth long enough for the newspaper articles and the media to say it'll never grow again, and then it grows again. And it grows because we're creative, we're entrepreneurial. We find a way to be better than our problems. We find a way to be better than our limited education system, our politicians, etc. So where's the economy? The economy is growing. We're adding jobs. Those are all good things. Manufacturing output is flat for about 20 months. That's not good, but it's flat very high. It's a very high flat. It's not a low flat. Employment's still growing. It's growing both because people who are already in the country getting jobs, and that population is growing, but it also is the immigration. The immigration is particularly starting to show up in the last year in the data.
Yeah.
Whether it's legal or illegal, you can't actually technically tell in the data, because the questions, especially in the payroll data, is just how many people are working. And so we are seeing that pushing some of the economy. I think it's good. So job growth is good. People say, how can job growth be so good? How can the economy be doing so well when interest rates are so high? And they are very high, short-term interest rates. And the answer is because most of the economy is not sensitive to interest rates. Yes, some parts of it very much are. Development, real estate development, very sensitive. Banking, we're in the finance and real estate business, so we're sensitive to it. But if you're a school teacher in Des Moines and you don't have lots of debt, you maybe have a mortgage, you locked your mortgage in when it was very cheap 2.5 years ago, you're not terribly sensitive to interest rates. If I use the following example, which is, I was just saying I went to an orthopedic with a 9-year-old who had just broken his toe. I didn't say, "Oh, we can't go to the orthopedist to see about fixing your toe because Powell hasn't lowered the rates." That's absurd, right? Or there's no one saying, "I'm not going to deliver a baby. I'm pregnant, but I'm not going to deliver until Powell reduces the rates 75 basis points." That's absurd. Well, healthcare is 17 to 18% of the economy, not interest rate sensitive. Government's like 33% of the economy, not state, local, and federal, not interest rate sensitive. If we need police, we need police. We need firemen, we need firemen. If the road needs to be paved, the road needs to be paved. They're not sitting there saying, "Oh, I hope Powell." You're well over 50% of the economy just on those two. Education. If you were sending your kids to college, you're not saying, "Boy, I hope Powell lowers." If your kid needs to go to college or trade school or something, they're going to go. And when you do that, you come up about 80% isn't very interest rate sensitive. And some is. So why is manufacturing flat, for example? Not all manufacturing, but because manufacturers finance themselves on inventory and receivable short-term lines.
Yep.
And so their cost has gone up and their cost structure has gone up. They've been adversely affected. Also, auto, for example. 2/3 of all autos are bought by people who borrow. Well, that's sort of short-term, intermediate-term borrowing. So auto has been hurt by it. So I'm not saying nothing, but lots isn't. Lots of people never borrow. You say, well, what about all the credit card debt? I don't know about you, but most of the time when you're using your credit card, you're not paying interest on it. You're going to pay it off in the 21-day grace period. It's a convenience matter, not a credit matter, right? So it's not for everybody. I'm not saying everybody, but for most people. So the economy's doing pretty well. One other thing I'd say about the economy and demand in general, there was this ridiculous notion, and you read Linneman letter, you know I had this in writing, and I said it on other places. We were never in danger of a recession 2 years ago when people were saying we weren't in danger a year ago. We're not in danger now. Economies tend to go into recession after 6 to 8 years of growth. We're in the third year. I mean, we haven't got massive excesses. We'll get there. Any of the massive excesses we had, they got wiped out by COVID, right? They got wiped slate clean by COVID. And we got a clean slate to go from. Now, that's not to mean everything's perfect, but we've still got lots of legs. GDP and employment still below trend. We're not even up to trend. Yes, but I thought we were adding 6 million jobs a year. Of course, we were adding 6 million jobs a year because we lost 20 million jobs. And so, and I think the Fed and others completely mismodeled this and misread this. By the way, remember, the US population grows about 2.5 to 3 million people a year. Well, if you're adding 5 or 6 million jobs a year, you can't do that forever, right? There's kind of a common sense. But if you had just lost 20 million jobs or 25 million jobs, thank God you did it for several years to get back, right? They viewed this through the lens of a typical recovery. So when you heard the Fed, for example, saying things are overheated, they're saying, well, jobs are growing in GDP, completely misread. Of course, they're growing way beyond norm. That's the best news possible. It's not like we were at norm and then way above norm. So I think the economy, demand, if you will, pretty good across the board.
Great. Well, with that backdrop, with a growing GDP and an expectation that that continues, that creates demand for all types of real estate. And you said, obviously, it's different for every sector, but that creates housing demand for multifamily and single family rentals. It creates demand for retail. What about the supply side of the equation, right? If we're going back to supply and demand have to be in balance, it seems like we started this recent environment, in a better place than we did during the global financial crisis. Where was supply? Where did it go after the pandemic, and where are we going from here?
I think you're dead on. You're dead on target. As I said, I'm 73, so I've witnessed a fair number of tough periods, let's just call them, for real estate. Generally, and the financial crisis, let's just use that as our example because some of the people may still remember it. Yes, the capital markets were in disarray, right? You pick up your paper in the morning and what major lender is going to be taken over by the government or forced into a merger here and abroad, right?
Yeah.
But also the supply and demand was out of balance for office. It was out of balance for apartments. It was out of balance for industrial. It was out of balance for hotels. So we normally have a situation that when capital markets are in disarray, it tends to also be in times where supply and demand have excess supply. So it's kind of the worst of all worlds. Your NOI is getting clobbered. You're beating your head against the wall, and on top of that, I can't get any money on top of that, right? It's kind of, this time's a bit different. It is hard to get money. But apartments, not bad, supply demand. I'll come back to that and say warehouse, not bad, supply demand. Hotels, not bad, supply demand. Could be better. It always could be better if you're an owner. But in the big scheme of things, it's not horrible. Retail, pretty good balance. You see the retailers' earnings reports this week, retail centers' earnings, they're all going to show decent growth. So they're not bad. Office, supply demand imbalance, right? So let me start there about what happened. What I'm now going to say is overly simple, but it gives you a sense of the office sector. Nationally, 10% vacancy in 2019. Today, let's call it 18 to 20% vacancy. Well, what happened was demand for space didn't change. Well, how'd the vacancy go up? It went up because in 2020 and 21 and 22 and 23 and 24, the pipeline of office buildings that were started in 17, 18, 19, 20 came online at about 2.5% a year. That's just crudely, right? 2.5% a year, and some got torn down, obsolescence. So, just imagine 2.5% a year, no new demand. You went from 10% vacancy to 12.5. Now you get 2.5% more. You went from 12.5 to 15. You went from 12.5 to 15 to 17.5, and then to 20. Now that's a little oversimplistic, but it's not so wrong. And in fact, in office, the office markets that are in the best balance are the ones that had slow demand growth. Why? Because they had slow demand growth, therefore they had smaller pipelines, right? Construction pipeline. So instead of bringing on 2.5%, they brought on 0.5%. So their demand didn't grow, but they went from 10% to 11% to 12% to 13% to 14%. Not healthy, but a lot better than if you brought on 2.5% a year for 4 years and no demand. So office is struggling. There's no doubt. Office is struggling. Net demand has been basically zero. People are starting. If I had to characterize office right now, it's probably 70 to 75% go to work on Monday in an office. Tuesday, Wednesday, Thursday, probably 90, 95% of previous, like 2019 levels. And then Friday's a national holiday in terms of going to the office. So office is, and there's no money for it. It's kind of what you're used to in the crisis. Too much supply, not enough demand, and no money. But if you go to the other sectors, let's take apartments as an example. Apartments are a lot more supply over the last 18 months than the preceding 18 months. Well, let's face it, what happened? If you had apartments started in 2020, you weren't allowed to build them in many communities. You had to stop, literally. Legally, you couldn't go. So there was a shortage of units that got completed in 2020 and early 2021. Guess what? They came online as you then get farther on in. So you got a supply spurt. And in addition to that, you had cheap short-term money brought about a supply. So what you had on the apartment side is, remember, we were getting 10% NOI increases on apartments just 2 years ago. Yeah. Well, that was because there was a shortage. Demand recovered, supply lagged. Supply is caught up. Guess what's happened? You basically got rents are no longer rising. Probably over the last, what would you say, 10 months, rents fairly flat, some markets down, some markets up. Rents have started picking up in most markets, but downtown Nashville and downtown Austin are still soft, and it'll take time, but kind of balancing. Same for warehouse. Warehouse had this period where they were printing money. Why? Because demand was growing, the economy was growing in 21, 22, 23, but the supply was lagging. Guess what happened? Supply caught up. You still have the best description somebody gave me of their warehouse situation is 2 years ago, we had 10 people doing a walkthrough for the space. Today we have 3, but 3 is not so bad. It's only bad if you compare it to 10. But 3 has got a normal-ish feel, 3 to 4 looking at the space. So it's okay. And retail's pretty strong. If you've got a good shopping center, well designed, well located, strip centers, pretty good shape. The 100 to 300 relevant malls, they're in good shape. The ones that aren't in the 100 to 300, they're struggling, but they were struggling before. So supply in decent shape, except office, not good that way.
So that's kind of spot today. What happens, you said earlier that interest rates create a significant strain on development. So we're now 18 months into this pretty dramatic tightening cycle. Where does that put that next wave of supply as we've kind of went through no supply, big supply? Are we going back to no supply?
Yeah, it's the beauty of markets in a strange way. They may overshoot both ways for a variety of reasons. Over time, they do equilibrate. So we went from not enough supply. Let's take apartments because it's an easy, not enough supply. Rents were going up almost double digit. That brought about supply. That supply comes online. Now you get almost no rent increases. But what happened was interest rates went up and rents went down. And guess what happened? As you know, supply is dried up, so that as we get to late next year, mid to late next year, 26, you're going to have a shortage. So, okay, your apartment's coming on. Let's suppose you have an apartment building coming online now, right now. It's leasing more slowly and it's leasing at lower rents than you were anticipating, but you're going to get those back in 25 and 26 because you're going to get more than you were deserving in 25, 26 because of the timing. So on average, you were right, but you weren't right either, period, is going to be how it tends to work out.
Yeah, definitely. All right, so the third leg of the stool, we call the demand for real estate. And obviously, interest rates have an impact there as we think about people and institutions being allocators of capital. There's been, a pretty significant repricing of real estate since the Fed started that tightening cycle. What factors determine that allocation decision for institutions and your typical client? What's the market sentiment today, and where do you think that goes?
So the flow of funds, of which mortgage debt is the most important. I mean, without mortgage debt, this is a very capital intensive asset, right? So without mortgage debt, things dry up. When the Fed raised interest rates unexpectedly and fast, they did both. They had just said we weren't going to raise them, and then like a month or so later, they're raising them very rapidly. That caught a lot of lenders off guard. They had balance sheet mismatches. They had various issues. We had a couple of banks go under. We had others stumbling around. When the interest rates went up, their balance sheets got holes put in them, shall we say. The big money center banks have plenty of reserves, though, however. This is not the financial crisis. The financial crisis and most of the previous, in fact, all previous financial situations, they had no money to lend unless somebody paid them off. Mm-hmm. And that's not the case. The big money banks have money to lend. They just are unwilling to lend it. Why? Because they don't know how deep their problems with offices are. They aren't sure when is the best time to lend. There's a lot of nervousness at their board levels, et cetera, et cetera. And at the end of the day, capital sources generally are herd animals. It's a survival trait. You say, I thought they were paid to take risk. They're paid to take certain risk. They're not paid to jump out of airplanes, right, with no parachute. That's a risk, but they're not paid to do that risk. They're paid in particular. Lenders are paid to take the risk of lending when others lend, not when others don't lend. Investors on the equity side, they're basically paid to take the risk of investing when others are investing. But when others aren't investing, they're not paid to take that risk. It's not a survival trait, right? If you invest when others don't, you could get eliminated if you're wrong. But if others are lending and you're wrong, you'll probably survive. And if others are investing when you are and you're wrong, you're going to probably survive, right? I mean, it's just reality of the world. So there's fear and greed. I mean, greed in a good sense. The cup half full, half empty is another way of saying it, right? And the analogy I always used is we've all had this where we've walked a certain street a million times. We know it's safe. We know there's no problem, but it's around Halloween. It's rainy. The leaves are rustling. It's dark. And we hear a rustle behind us and we get frightened and we pick up our pace, and that's what happened to the capital markets. There were some fundamental things. They heard some rustling. They got panicked. There's no reason to act until everybody else acts. But eventually they will. And when they act, as you know from your career, they go pretty quickly from fear to greed. And that's because if everybody else is lending, I'm being paid to lend when everybody else is lending. And if everybody else is being paid to invest equity, and I'm not, tough business model. And so these things swing faster. When they swing faster. Now, one of the most, I don't mean to toot my horn, one of the most important pieces of research I've done in my career is analysis of what determines cap rates. And I find that interest rates don't determine cap rates very much at all. What determines cap rates? And the answer is what your third leg, the flow of money. How much do people want to put out money to buy real estate? If they don't want to put it out for whatever reason, the reason doesn't matter. If they don't want to put it out, cap rates go up. And it doesn't matter what the interest rate is. We've seen high cap rates with low interest rates. We've seen by the way, the financial crisis, we had low interest rates and high cap rates, right? Right now, we have high cap rates and high interest rates, relatively high. And we have other episodes. So it's not the interest rate. How could you have high cap rates both in the financial crisis when interest rates were low and today if interest rates drove cap rates, right? Yeah. And it's the flow of money. When money doesn't flow and you're a capital intensive asset, you're in trouble. You're in trouble in terms of value. You're in double trouble if rent and occupancy are also in trouble at the same time. So office, rent and occupancy in trouble, and capital isn't flowing, real bad time. Apartments, not double trouble, just trouble, right? And again, if you're maybe downtown Austin, could be double trouble, but generally, same for a warehouse. You're generally not in double trouble. You're only in the capital side. Capital side will resolve. Capital side resolves also because of economic growth. People don't understand this. The economy's growing in nominal terms, which are relevant to what I'm about to say. In nominal terms, the economy is growing like 4% a year. Okay? Now, why does that matter to the capital side? the economy is growing at about 4%. It means people have about 4% more money to deposit. And where are they going to put it? A lot of it's going to go to banks, and they're going to have about 4% more to invest and so forth. And they're going to give it to capital sources. Now, in a year, that doesn't matter much, but you do that for a couple of years, you solve any capital problems pretty quickly with a couple of years of 4 or 5% nominal growth, because suddenly they have money to lend and the dam breaks and it comes out. And people say, well, but wait, the weighted cost of capital, or the cost of capital for the incremental buyer, went up when interest rates went up. And I say, yep, that's absolutely true. I'm not denying that. That's not the factor I'm denying. But what my research shows, and the two little financial crisis versus today, I mean, interest rates very different, cap rates similar. I make the analogy that interest rates in a fundamental way kind of affect cap rates in the same way that the seabed. Imagine a GPS point, 40 yards offshore. A lot of you are at the shore this summer. Imagine a GPS point 40 yards offshore. And you measure from the seabed to the highest point that water achieves, day after day, hour after hour, okay? Well, changes in the seabed do affect how high the water is, right? Erosion or buildup, they affect how high the water is. That's the interest rate effect. But what really determines how high the water is at any moment is the tide in or is the tide out? Are there big waves today or are there no waves? Is it pouring rain right now or is there no rain? That's the capital flows. So I'm not denying that changes in the seabed have an influence. They're just small. When you compare how is the water height changing moment to moment, day to day, week to week, it's those other factors that are swamping it. And that's what I find in the research. What are those other factors? Outlooks on growth, outlooks on fear, outlooks on risk. Those swamp it. Capital flows, those swamp the fundamental interest rate, the seabed, if you will. So what does that mean looking forward? I don't know how long the money sits on the sideline, but I do know it doesn't sit there forever. And I know when it comes out, cap rates are going to fall. They're going to fall. And they're going to fall probably on the base. They're going to fall pretty much back. Again, I'll take apartments only because it's a transparent pricing because of mark-to-market rents. If an asset, a good asset's going to have a 4 to 4.5% cap rate on NOI. Going to have a 4 to 4.5% cap rate. That asset right now probably has a 4.8 to 5.4% cap rate. Hard to know, not a lot of trades, right? Not a lot of trades. And you can do the same thing to other assets similarly, adjusting for mark-to-market NOI. So I feel good. This is actually, I think, a good time. Why? Because if you have capital and you have courage in a capital-intensive business, when people either don't have capital or if they do, don't have courage, you'll generally win if you can stick around long enough for the victory, because you don't know when the victory lap is going to be. You don't know when the capital returns, but you do know it will. So I'll go back to the financial crisis. Don't you wish you'd have had endless amount of money and endless amount of courage in 2009 and 10?
Yes.
I mean, you'd have bought, with hindsight, you'd have bought every apartment, you'd have bought every warehouse, you'd have printed money over the next 7 to 10 years. You'd have bitten your fingernails the first year or so, right?
Yeah, absolutely.
You did. And by the way, you'd have locked in interest rates at too high a level, right? In 2009 and 10, because money didn't want to be there. And yet you still printed money. And that's because you got in when others didn't. It was the reward you got for having capital and courage. And as I say, capital is rare, courage is rare. The combination of them is particularly rare at times when courage is necessary. Having weapons and courage and the right moment to save someone is a rare combination. And when you happen to have it, you become a hero.
Yeah, really interesting. And when I think back to those times, talking about nail biting, just given the backdrop where office withstanding, where you don't have the two negative things going against you. You don't have really soft real estate fundamentals and have to be willing to have the courage to be before the capital wave. It feels a lot easier this time, in my opinion, to dole up that courage. But again, you're still going to have to do it on a day when the Wall Street Journal is going to drop an article about
That's
a struggling bank or a struggling asset or an asset going back to a lender. So the courage is going to have to be there. I think you're dead on right there.
and by the way, let's take apartments. Um, as I say, rents are probably going up 0 to 2% right now, which is not spectacular. So you're going to get in and you're going to get, year-over-year increase, let's say of 1%, and your costs are going to go up 2.5%. You're going to go, did I make a mistake? But then the factors we talked about will kick in, the shortage next year to win. My departed friend, Sam Zell, I learned a lot from Sam, enjoyed Sam. And Sam, I'm paraphrasing, would say, all these people say they wish they'd have been around in 73 to 75 because you could have made a lot of money investing in real estate, or 80 to 83 could have made a lot of money, or 1989 to 95 could have made a lot of money. And he said, and the financial crisis, 2009, 10, early 11. He says, but people really didn't want to be around then. It was the only reason I could make outsized money is people didn't want to be around then. If people would wanted to have been around then, he wouldn't have made outsized money in those cycles. Now, I think you're right. You may not make quite as much outsized because you only have, you don't have the double problem, except in office. You do have a double problem in office.
Sure. Makes a lot of sense. I guess we'll kind of wrap up here with kind of one last thought. Obviously we've been this interplay between transitory inflation and inflation being sticky and interest rates. And we already kind of unpacked, that the interest rates are not a direct correlation to cap rates, but they do have some impact on the flow of money. How many people, keep
Absolutely.
money in money markets and other things. And we're seeing, those decisions being made. What is your, we obviously read your forecast in the Linneman letter about interest rate cuts. What's your thought through the back half of the year and into 25? And do you think that the read on inflation is accurate? We all, as investors in real estate, understand the challenges with reading in the way that we read inflation, particularly with housing. So just, kind of quickly give me your thoughts on those couple of things, and then I'll let you get back to your life here.
So first of all, inflation by CPI and personal consumption expenditure indexes are known to be grossly mismeasured, but they're consistently mismeasured. However, this particular time, one of the ways they're very badly mismeasured is sending very false signals. And that is, they give a huge weight to housing, okay? Not housing like a homeowner's price, rent, and a concept that's screwy. It's not even a reality, which is, how much do you as an owner pay yourself in rent? And people go, what? I don't pay any rent to me or anybody else. Well, according to the CPI and the PCE, you calculate what that rent is each month. And we don't have time to go into how, it's screwy, but it's an absurd idea because unlike bubble gum or an apartment rent or the painting behind you or your shirt, somebody bought that stuff. The owner equivalent rent, no one has ever purchased in history.
Right.
However, it's 24% of what creates the consumer price index, 24%, and 12% of the personal consumption expenditure. And it, for a variety of reasons we don't have time, has been coming in really, really high. Okay, so you go, well, so what we've got is an item that people don't purchase. No one purchases, coming in high, causing inflation to be measured much higher than it is. And that's been true now for about a year. Okay. So that's the first thing. Second thing is, yes, you can look at year over, let's not carp about measurement. Let's just take it at face value. You've got, if you take an average between personal consumption expenditure and CPI, neither one is right or perfect, as I just said. If you take an average of the two, you'd say about 2.5% inflation year over year. Okay. But that's like asking, what's the average speed you've been driving the past year? I want to know how fast you're going right now.
Right.
Right now. Because I'm interested in how much inflation are we experiencing right now. And so I tend to look at month over month or 2 months over the preceding period, or maybe a quarter. Why? Because I want to know the speed we're doing now. Well, the speed, both of those indexes have done over the last 2 months. So if you take what it was, the level was 2 months ago, headline, versus what it was the last data point, 0 is the answer. 0. And if you make any adjustments for that silliness of the owner equivalent, it's slightly negative. It's a bit negative. So in that sense, inflation's gone. Why is inflation gone? Inflation occurred not because of the Fed. Inflation occurred because the pandemic shutdowns occurred, supply shut down, workers stopped working, and demand came back faster than supply. It did it for apartments, it did it for bubble gum, it did it for shirts, it did it for hotel rooms, did it for airline seats. And when supply lags demand systematically, you did get prices go up, and that was inflation. Unlike most inflation, this was bizarrely a good inflation. Why was it good? First of all, wages basically slightly outstripped price increases. And that's because, remember, we had a shortage of labor. I mean, you know that. Everybody watching knows we had a shortage of labor. You know what happened with wages. And so wages, which are a price to somebody, actually outstripped consumer price inflation. All right. But what did the rising consumer prices do? They sent out a signal, we have a shortage here. We have a shortage here. How do I know? Look at how high the price is versus a historic norm. Look at how high the profits are versus a historic norm. Bring on more supply. And it was good in the sense it signaled to bring on more supply. And guess what happened over the 2023 and now into 2024? Supply came back. Supply caught up with demand by almost every metric. And what you saw was, last 2 months, no inflation. Now, I'm not saying we have no inflation forever, but it's gone. It's gone. And it's not gone because of what the Fed's done. Fed's probably helped. What's really, interest rate policy had no effect on the ships in the ports, right? Sitting out in the harbor. They had no effect on that. They had no effect on whether a restaurant opened. They had no effect on whether an airline brought more seats online. If anything, the effect of high interest rates was to reduce the number of seats airlines brought. It's reduced the number of ships. If anything, it perversely worked. So we eliminated inflation because this was bizarre the way it created. It was the most bizarre economic event in my lifetime. This was not a typical inflationary cycle, anything but. Why are people say, but we still have high inflation? That's a matter of verbiage. What people are really saying is prices are a lot higher today than they were 3 or 4 years ago. That is factually true. But so are their wages. And there's a sense where people want that the wages are 23% higher because they believe they deserve that. But they don't want that prices are 20% higher than 3 or 4 years ago because that's unfair. Well, you could have had prices not go up and get 1% a year increase in wages. You'd be at the same net point. But there's a lot of psychology going on to this. And the psychology of it is all, I suspect, pretty complicated. So, yeah, I mean, prices have stopped rising. Then people say, will they go down? No, they'll go down only if supply notably exceeds demand. But if you're a supplier, your goal, no apartment developer is saying, well, we got really good rent increases, more than we ever deserved. So what we're going to do is create not only enough supply to get back to balance, but we're going to overshoot so that rents can fall to the point where they were in 2019. That's absurd. No bubblegum manufacturer is doing that. No restaurant is doing that. So what happens is prices will go up more slowly from this point, much more slowly. That's inflation is gone. Notable inflation is gone. But they're not going to go back down to where they were. And thank God, neither is your wage. So, and by the way, and I'm old, nor is my Social Security, which is indexed to inflation, right? So, I mean, you could take people on Social Security as a kind of, gee, my income went up actually slightly. Your income goes up by the increase in wages. So I outstripped inflation because I went up at the wage rate. But that's kind of what the economy did. And people say, well, not everybody. Nobody ever, right? Nobody ever. It's an average is an average.
Yeah, absolutely. Really
So what
interesting.
that leads to, I didn't finish the punchline is I've been saying for a year, at least 3 interest rate cuts. Why? Because I saw inflation disappearing. And in any rational world, if inflation is down where it's at, which is realistically, if you only look at items people purchase year over year, it's below 2%. And I told you month over month for 2 months is 0. Why do we have a 5.25% interest rate to a safe borrower? That makes no sense in a world of no inflation. Maybe you could say, well, right now inflation is too low. We overshot a little on supply. And inflation is going to be 1.5%, which it had been for the previous 20 years. So if it's 1.5%, the short-term interest rate should be about 3%. And by the way, even if you believe it's 2.5% inflation, the headline number, fine, it should be 4% short-term interest rate, not 5.25. So I've been saying at least 3 interest rates cuts this year. I still believe it. I said to my friend Willie Walker, it's going to happen before the most recent inflation data came out. And he said, if I'm right, he'll kiss my feet. And I sent him a picture of me choosing which shoes I'm going to be wearing when he kisses my feet at the end of the year. They're going to cut. I haven't heard what they've done today, but I presume they're not going to cut today. They're going to do, they don't meet next month. They'll cut in September. They'll pause in October and they'll cut in November and December. And people say, why do I say November and December? Because you're going to get next month's inflation number is going to be about 0 month over month. And the following month's inflation month over month is going to be about zero. There's some technical reasons why we know that, which means it's going to just keep pulling down the year over year. And they're going to be looking at 3 and 4 months of zero. And that's going to frighten them. And just remember, the same people who are telling you we're not going to lower rates very fast are the same people who told you we're not going to raise rates very fast and did. And they're going to get terrified of deflation about as quickly and about as late as they got terrified of inflation.
Yeah. Yeah, I tend to agree with you. That's really interesting. Well, Peter, thank you so much for your time today. This has been great. Really enjoyed your commentary. Really enjoy the work you guys do with the Linneman Letter and also with your charity. So
Thank you so much. It does a lot for we do education over there for children of mostly orphans and destitute children. And, we have some great success stories, really some amazing success stories over the last 20 some years. So anybody ever wants to go to Kenya, reach out to me and I'll give you some insight. You can visit some of my kids. And thank you for the opportunity to address you today.
great. Thank you so much.